Good morning and welcome back to the NWR Virtual Investor Conference Series 11. I'm your host this morning, Banjo Blake, and next up we have Money3. Money3 is a specialist provider of automotive consumer finance in Australia and New Zealand with a focus on providing secured automotive loans to customers that traditionally have difficulty procuring mainstream financing from traditional lenders and finance providers such as banks. Money3 collectively manages a growing profitable loan book of 556 million in gross loan receivables across 60,000 active customers. Speaking on behalf of the company today, we have CEO Scott Baldwin, who has been with Money3 for a total of 14 years. Thanks for joining the NWR conference today, Scott.
Thanks, Banjo. Appreciate the introduction. Loan book's grown a little bit since those numbers we've given you, a little over 700 million now. But we'll go through that in the presentation. We'll start with just a little bit of background for those that are new and unfamiliar to the Money3 story. So as a group, we provide secured loans primarily for vehicles, cars, bikes and boats. We have 3 businesses that we operate in Australia and New Zealand, and those businesses fund those assets either through brokers, dealers or customers that come direct to us. At this point in time, we originate about $40 million a month of funding that comes in through those 3 channels in those 3 businesses to us. One of the key differentiators between Money3's business model and many of the peers that you see out is, look, we've been here for over 20 years lending money, and we've found that the niche that we play in, principally used vehicles, but growing in the new vehicle funding segment as well. But principally in the used car market, we spent a lot of time working with our clients and built quite a large customer care team. So a large team of professionals that are managing those repayments cycles for customers through the journey of their typically a 3 to 4 year car loan. The journey of application through Money3 is very different from many other lenders. It's very tailored to, very customer-centric, tailored to where the customer is buying the asset from. So as a group, we have spent essentially the last decade perfecting our technology, that when you walk into a dealership, that the sales manager is typing the customer's details straight into our software to improve turnaround times for settlement. And if they're coming through a broker, they're often capturing the customer's information through many broker portals, many broker technology, and then pushing it straight into the Money3 lending platform. And then we also have the direct to Money3 business, which is usually through a group of affiliates or through websites. And that's very much what we talk about when we talk about our ubiquitous customer journey and technology. It's that integration that has taken us many years to perfect. It is one of the reasons why we're taking market share, and one of the reasons why we've been able to continue to shave turnaround times down over the last 3 years is through that technology investment. We do operate in Australia and New Zealand. And look, I think one of the core differentiators, many players in that space, is that 20 plus years in market, the well over $2 billion of lending, having serviced over 500,000 customers, currently active customers around 75,000. And through that whole 20-year journey, and particularly since listing, we've been profitable the whole time. These are our 3 business units. Money3 is the core business unit, also the parent name. That's where we started. We acquired a business a little over 12 months ago, Automotive Financial Services. That's our recent acquisition. We'll come back to that. And 3 years ago, we acquired a business in New Zealand called Go Car Finance. We acquired that team of about 80 professionals over there to help us build our brand and build our business. Now over $200 million of receivables. In the 3 years we've had it, we've grown the business 4 times. It's making a solid contribution to our business. We do call out in here that we have had a little bit of weakness in that business from opening up the pandemic, particularly in February and March. I'm pleased to say that we've seen things start to return to normal there from April onwards. Every week we see better performance. And it's very similar to what we saw in Victoria when it went through the lockdowns. We did it a couple of times here, but we see that opening up demand slowly picking up in New Zealand as confidence returns to that and people can get out and buy a new asset. AFS has been with us about 12 months so far, a little bit over 12 months. We think the same journey and the same things that we did at the Go-Car business will be able to apply to AFS. And we've seen that business double in size in the 18 months that we've had it. We think it's on a journey where, similar to what Go-Car, introducing better funding, helping them with their technology stack, introducing new partners to increase their monthly volumes has all worked quite well for us. They're now actually writing 4 times what they were in the first month we acquired the business, and that is continuing to grow. So we're very confident that AFS will follow a similar journey to Go-Car Finance over the next 2 years. Just a quick update on how we're going, how we're performing year to date. Revenues of $139 million, up 32%. A lot of that is driven by just the increased volumes that we've found within the market. There is a massive amount of change happening in the market with big banks exiting the sector. Lots of volume out there for many players in the space. As I was saying before, our key focus was the used finance for a used vehicle. We're growing our market share by growing our presence in the new vehicle space. There's a slightly different credit quality aspect to that. And we've also started originating more commercial loans as well. Small part of our overall receivables, around $20 million, but it is growing and it is helping us grow our market share. And these are things that we're calling out that, as we've become one of the larger players of funding for a used vehicle, moving out into those bigger markets, broadening our market appeal, and continuing to bring what we do, integration of software, very customer-centric, fast turnaround times, and reasonable price products to consumers is why we are confident that our business momentum continues. You'll see, if you look at the last 5 years of our journey, pretty much every metric from revenue to profit has grown in excess of 20% year in, year out. And we're confident that next year continues to do that. I really want to call out bad debts. Been a lot of conversation about what inflation does to bad debts. What we're seeing as a business is that the price of a used vehicle is remaining very solid. We're not seeing, in fact, I think we're possibly starting to see lead times for new vehicles get a little bit longer again. It was improving, particularly at the end of last year and coming into this year, but the longer it takes for new vehicles to arrive in the country, the stronger the demand and price for used vehicles, which is quite good for us, for any consumer that is having any problems with their loan. They're able to sell their car and solve their problem. Bad debts sitting at this point in time, we're expecting around 3.7% for the year, is at a record low for our group. And what you'll see in the next slide is the impairments through the segments in our business. And you'll see that the credit impaired segment of our business, less than $1 million of our $700+ million of receivables is in that credit impaired segment. It's the lowest it's ever been. It's continued at that for a number of months now. It's testament to the resilience of the economy and the ability for people to, or I should say, the fact that customers really value their vehicles in this current market, that they're getting ahead on their loans and wanting to make sure that they stay up with their payments. So bad debts continuing to be very positive for the group. Available funding, you'll see in future slides, over 100 million of available funding. Should look at that with the cash component as well within our business. So if you look at where we are, we now have all the building blocks in place to build to $1 billion of receivable, which we're confident that we will get to next year. New lending, 40% growth year on year, driven by those initiatives we talked about, and very confident that we have the right momentum coming into FY23 for another record year next year. Just moving on, we'll start with the improving loan book quality that you can see here. The very thin yellow line is the credit impaired segment. That's basically our forward flow into bad debts. And as you'll see, it's at record lows. We'll update this for the full year when you get full year results. But that's what's giving us the confidence that next year our bad debts stay within that band of 3.5% to 4.5%. And we think with overall improvement in credit quality that we continue at that space. At the start of the pandemic, Money3 made some very conscious decisions to tighten its credit quality. We haven't wound back to where we were in 2018-19 because we're seeing those positive benefits of improving the credit underwriting algorithms within our business flow through to the bottom line, and we think that you'll continue to benefit from that. Loan book continues to grow. $40 million a month is roughly where we are at the moment. We are expecting continual growth within our business, particularly as New Zealand starts to pick up again, which we're seeing, and as our AFS business continues to grow. So very confident of seeing us hit that $1 billion next in 2023. And we've talked about the funding headroom. We'll move to the next slide. Just in terms of the outlook, and then we'll go to questions. We are confident of exceeding the 50 million NPAT that we proposed. Our new lending, we expect to be up well over 30% on last year, 430 to 450, getting very close to advancing $500 million a year in new lending. Cash flow continues to be very strong across all of our business segments, particularly the Money3 business segment. And just looking out for next year, things that are giving us confidence that next year is a very strong year. Demand is moving to record levels. Every day we look at our incoming applications, they are exceeding 2019, and they're also certainly exceeding where we were last year in 21. So we're confident that increasing application volume continues to drive growth. Strong cash flows, strong used car prices, all underpinning a very solid result that we expect to come in 23, because vehicles are maintaining their prices. We can't see any of the macroeconomic inputs that are going to drive down used car prices at this point in time. We think that's going to persist for at least the next 12 months or beyond, which will help us deliver another record result next year. And we talked about that application volume growing. Hand it back to you, Banjo, to see if there's any questions. That's a quick update for investors.
Thanks a lot, Scott. It was great to see growth over the quarters this year and continuing into next year as well. Just got a few questions, and an attendee, congrats on the really strong update. A couple of questions. You've posted today 39 million NPAT to March, so 13.2 million for Q3. This puts you on track for 52 million in the full year. Is there anything unusual to expect in the fourth quarter of this year?
Not really. We're a third of the way through it. Things remain positive. We've chosen, not to upgrade or change our guidance. We've said it's north of 50 million. There's a few accounting movements there, but we're very confident in being within that range.
Finance companies are being impacted by concerns about rising interest costs and future bad debts. Are you able to discuss how Money3 might deal with each of these?
Great question. I think we talked a lot about the bad debts and what our confident rising prices, strong cash flow, and a low impairment going into next year. All of these things give us confidence that next year continues to be within that trend, 3.5% to 4.5% bad debts, which is factored throughout our business model. So really confident in bad debts. Let's talk about rising interest rates. Money3 as a business, as we call out in our deck, is roughly 50% equity funded, 50% debt funded. We're a very different structure to nearly every peer we have in the market, given that we have a very large equity base. That equity base is not repricing because of rising interest rates. And the other component, given that we were probably a little bit late to the game in terms of bringing our 4-bank strategy to bear, we have 4 large Australian and international banks funding the group now, and we also have 1 provider of mezzanine finance there today. That we've done that over the last 2 years, and what we are expecting is that we will continue to have margin improvement as the amount of money we borrow grows. We've built that into the facility, into the nature of the agreement. So we think that over the course of the next 12 to 24 months, that our cost of funding continues to improve by 100 to 150 basis points. And we're very confident that that will offset the likely increases that may come through from the RBA. So they're the concerns. Let's talk about and have investors think about what is the positive for Money3 in the group. We are half debt, half equity. We have a very strong balance sheet. and we write profitable business. We are growing rapidly. We have the luxury of considering whether we pass on those rate rises to our customers or bear it. We also expect to see improving cost of client acquisition as our peers deal with rising costs, far more challenging than our business model. So what we're expecting is to have more flexibility in terms of our pricing to the end user, and also having the opportunity to acquire more clients at a lower price of client acquisition than we have in the past. So for us, we are embracing rising interest rates. We think it will benefit our business model far more than many of our peers within the space. So we're excited by the prospect of sort of a 100 basis point improvement or lifting of the RBA rates, because it does drive more application volume to our business without us actually having to do a lot of incremental marketing to get that volume. So that improves our costs far more.
Just on acquisitions, does the current environment make the prospect of acquisitions any easier?
We're moving into that period. Money3 has always been an acquirer of businesses that strategically make sense or are at an appropriate price. And if you look at the last two, we bought the Holden Financial Services business. We paid a very good price. It's made money for us. We are open to acquisitions like that. There have been none available really in the last 2 years, but as we move into the next phase of the market, I think those opportunities will come, and we are still open and looking for businesses that strategically fit with our model within our space. We consider 3 markets of being our core that we want to play in: used vehicle finance, new vehicle finance, put them together, business lending for assets, cars, bobcats, vans, and personal loans. So strategically, they're our product segments. Distribution are well known through the 3 channels and in Australia and New Zealand. So that if we can find a business that gives us leverage into one of those spaces that we can bring what we do to help that grow, we would be interested. And to answer the question specifically, I think the opportunities are going to continue to increase from here.
How do you see, with impeding rate rises, your competitive position in the market versus your peers?
We talked a bit about that. I think we're at the head of the pack. Strong balance sheet, already profitable, and a very strong customer care element to our business. So, we don't outsource any of our collections. We do it all internally. We've built many years of experience there in doing that. We've been through downturns before in 2008 to 2009. I think we're at the head of the pack in terms of our ability to respond to rising interest rates, and the acquisition thing, some people won't be. That'll give us opportunities in that space.
Can you expand on the key OPEX increases you expect or require into FY23? Should we be expecting a 20% increase over the remainder of FY22?
Look, as our business, it's been very small. OPEX has grown somewhat in line with revenue as we continue to invest in technology. Over the last couple of years, it's very much been investing in things to do with the pandemic and cybersecurity within our business. We intend to grow our OPEX slightly under revenue growth, because what's there is what we're going to reinvest back into the business. At this point in time, we see an opportunity to continue to make an investment. We've preferred to expense all of that in the year that we do it, rather than capitalise those and draw it out over time. But it is building a more resilient business. So yes, OPEX will grow slightly at a lower rate than revenue growth at this point in time, and it's the investment in technology that is principally driving that cost.
Are you seeing a levelling off in terms of used car prices? And if so, how does this impact Money3's business?
Yeah, I don't feel the business as a whole has seen a material increase in the average loan size or used vehicle price this year. was very much last year's conversation. They're just maintaining that, and everything that we see suggests that they're probably going to stay there. If anything, what's going to drive up used car pricing will be the new car market repricing their assets. As supply becomes more constrained, a new car is being repriced up. I mean, dealers are not feeling any pressure to sell under recommended retail. So that means the average price for a new car is creeping up, and that's dragging new cars up only marginally. So from our business, we're not expecting any material rise in used car pricing over the forward period. And we think we're a couple of years away before you start to see that normalise. If we see them come back, I mean, I think it's a few years away.
Is there any change to the revenue yield we should be assuming in FY23 on your average loan book?
Yes, there is. So as the AFS business continues to grow as a percentage of the overall receivables, the overall gross yield will come down. We expect no more than a 200-point reduction over that period of time.
Can you please make a comment on the principal amortization given strong cash receipts?
I have the benefit of Siva sitting here with me, and since that's a very accounting question, I'm going to let him answer that. You can't see him, but you'll be able to hear him in terms of the...
Thanks, Scott. In terms of principal amortization, look, it is not too rapid in the sense there are some early discharges, and that was more a factor of early in the financial year. Things are slowly getting to normal. What you are seeing today with respect to excess cash collections is 10% more than what they need to do on a weekly or monthly repayments, as opposed to what I would call as a technically early payout when we had the super releases in the past. So things are slowly getting into the normalized section as we get into FY23.
And time for just one more question. With the business experiencing strong momentum and a strong outlook and somewhat depressed share price, what consideration is there for a buyback?
Look, the share buyback is on the board's agenda. It's being discussed. It is being discussed and considered as one of our capital management tools. We're also considering the desire to continue to maintain or improve dividends over the journey as well. So the board is considering both of those, and I would say when we've concluded on that, we'll make an announcement to the market.
Thanks a lot for your time, Scott and Siva. Appreciate the update, and all the best in the future for Money3.
Thanks, Banjo. Appreciate the time.
Thanks a lot.